Today on Money Life.
Still going to have recessions. We haven't repealed the business cycle, and we're still going to have market declines associated with that. But I just don't think that's the way to approach your investing. I think that's going to lead to a lot of false positives in terms of recessions. In 2023, everyone was forecasting recession. It didn't happen. After the tariffs were imposed, we had another market decline. Investors were expecting recession, and that didn't happen either.
That's Ed Campbell, founder of Red Hook Phoenix Investment Partners, longtime head of dynamic asset allocation at PGIM. And he's here talking about mega trends, including the end of boom and bust cycles, which he says helps to explain why it has felt for so long that we needed some significant downturn, but we haven't actually had one. He's our big interview today, but we start with Todd Rosenbluth, the head of research at Verify. And if you're nervous that the market could lose ground, he's got a pick this week that's virtually guaranteed to not lose money no matter what the market conditions. And in the market call, Adam Coons, Chief Investment Officer at Winthrop Capital Management, returns to the show after a couple of years, and we will be talking ETFs.
Where's the beef?
Well, the beef, if you're looking for the meat of the show, is what's going to happen in a few minutes. The beef, if you're looking for the beef between people, is what's going on in Washington where we've got a shutdown. But either way, the meat, we're going to give you as much as we can without much frills. This is Money Life for October the 2nd. Thank you so much for joining me. My name is Chuck Jaffe, and I am your host here, and this is Independent Personal Finance Talk, and we try to cover a lot of ground. And we're going to do that today with Ed Campbell, longtime executive at PGIM, the investment management arm of Prudential Financial, has broken out on his own with Red Hook Phoenix Investment Partners, does some work with Dave Rosenberg from Rosenberg Research, who, by the way, will be here later this month. And I really wanted to talk with him because his new firm really looks at where AI and nuclear power come together. And that is not a place that you necessarily think of immediately, but a whole bunch of you said, I want to get more on these stories about not so much AI adjacent, but AI changing things, right? The story that Rob Thummel from Tortoise Capital told, where he's looking at infrastructure companies and he's considering Bitcoin miners as infrastructure companies because they did so much to get power sources. Well, AI now needs all this electricity and all this power, so the guys who have power become viable in a different way. That was Rob Thummel's story. We're going to talk a little bit more about that and much more with Ed Campbell, but overarching everything, he basically says we've gotten to where there are going to be fewer boom and bust cycles, though there will still be recessions, as you heard him say, and downturns. That's probably good for all of us as we watch Wall Street climb a wall of worry and we're less worried about a bust per se. I don't know the number for you. The number historically for people has been 15%. If you see a 15% decline, that's when people start to get out. 20% feels much worse than that, but 20% doesn't really even bug me at this point. I'm not saying I'd like to go through it, but when Christina Hooper from the Man Group was talking earlier this week about a 15 to 20% decline, if we saw a 15 to 20% decline and it happened over the span of even a year, I would worry much less than if we saw something that either was much longer than that. We saw a 20% decline that was just spread out and you had 2 years of ugly, or that you saw some bigger decline at a spot where, again, my worry is sequence of return risk. My personal worry for me, because I'm a 60-year-old man, and at some point here, I'm going to retire or cut back or do whatever. It's not for a while. Do not worry. I'm not going anywhere, et cetera. But you have to, maybe it'll just be Gail who is planning to retire, and she will get to a spot where she says, okay, I'm retiring. And then you go, now, as she retires, if the market were to tank, how does that impact things? That's my worry, because it's the thing I can't control for. But if you're going to tell me that we're going to have fewer boom and bust cycles, I'll be happy with that. Not happy with what I'm seeing in Washington, but we don't talk politics here. We do talk about how it impacts the market. I think we will have to do some more if this one runs on for a while. And as this goes on, even just in the early stages, I do think it will run on for a while. Let me know what you want to hear us talking about, what you're hoping that we will bring to you on the show. If you like certain people, you want them back, all that other good stuff. We have a great lineup coming. I will tell you all about it, or at least partially about it at the end of the show. But man, some great stuff coming as we're now into October. And then you get to November and December, where we are talking about tons of outlooks for the new year and a lot of great guests coming on. So it's an exciting time for us. Always is. We love what we do here. So that's the best part of it all. Chuck at MoneyLiveShow.com is how you reach me. But right now, you've reached today's show, so let's get to it. Todd Rosenbluth, Ed Campbell, Adam Coons. It's great to have him back on the show. You'll appreciate all of them when the talk starts right after this message.
Exchange is more than a finance conference. It's a community. The insights, connections, and strategies you'll gain will last long after the event ends. Join us for the most valuable few days of your year. Exchange 2026, March 15th through the 18th in Las Vegas. Visit exchangeetf.com to register now.
One fund on point for today and the expert to talk about it. Welcome to the ETF of the week. Yes, this is the ETF of the week, where we get the latest take from Todd Rosenbluth, the head of research at Vetify. And at Vetify.com, you'll find all the tools you need to be a savvier, smarter investor in ETFs. You'll get more of the details on the new, newsworthy, trending, and timely ETFs that we talk about here. Todd Rosenbluth, it's great to chat with you again.
It's great to be back, Chuck.
Your ETF of the week is
the Campbell's laddered S&P 500 structured all protection ETF, CPSL.
CPSL, the Campbell's laddered S&P 500 structured alt protection ETF. It is not just a mouthful. This is a tough fund for us to explain because it is a fund of funds. It basically invests in 12 other funds, if I understand it correctly. Those 12 funds being short duration ETFs that are very specific. So why are we stepping into this one and all of its complications now?
So I think this is quite simple. If you think that the market is likely to pull back, as many people do, we are recording this on Tuesday. I feel like I'm a broken record. We are recording this on Tuesday. The government is expected to shut down at 12:01 on Wednesday. By the time people are listening to this, either the government will have been shut down or terms will have been agreed to and the government doesn't. I think that makes a lot of people nervous. So CPSL came to mind to me because despite all of the moving parts, what's simple about this is if you're worried about the market going down, you want close to 100% downside protection, and you want to have, you're willing to get only some of the gains of the S&P 500. This is the right ETF for you to be able to do that. There's a lot of things that are under the hood, and we can dive into that. But if you're nervous, either for a short time period or a longer time period, CPSL can help you to sleep at night.
Yes, and I will point out, completely unrelated to the shutdown, I've had a number of folks tell me on my show, Money Life, that they think the market is due for a decline. Some a small technical decline, some something bigger. But if you have that nervousness, a fund of this type, not this specific fund, is designed to eliminate some to all of the downside risk. This particular fund basically says you're not going to lose money, but explain how it accomplishes that, because it's not like, hey, you're sticking your money in the mattress.
Right. So this is an ETF from Campbell's, like many of their ETFs, that's using options. So using options, you can protect the downside, and in exchange for protecting the downside, you limit your upside. And so actually, it was almost a year ago to the day where I talked about one of these underlying funds that's inside CPSL. It was a structured protection ETF on November, and it was around Election Day. I think we might have been recording it on Election Day. We weren't sure at the time how the election was going to go and how the market was going to react. The downside to having a fund like that, which was the November series, is that it matters when you buy it. So your downside of, or limited or zero downside, is in the 12-month time period. So If you bought the November fund later on in November, or even in December or in January, if that was the case, then you might end up having downside. So the laddering that's in this name here for CPSL is there are 12 months of the year. There are 12 ETFs that are represented, one for each month of the year. And when I looked beforehand, on average, there was 96, 97% downside protection. So not 100% downside protection, but for people who are buying at any point, it's close to 0% upside. And there's an upside cap of 6 or 7% for each of those individual funds. So if you like to limit to close to zero and get around 6 to 7% for whatever time period you had in mind, CPSL can do that as a standalone. And I don't want to get ahead of where you're going to go next and on how else it can fit in the portfolio. So I'll let you talk this time.
The 12-month structure thing is important because what's happening here in this ladder is functionally Calamos creates a new fund every month. That's a 12-month fund. The old fund rolls into the new fund, and it's all part of this bigger fund, so that rather than having one or trying to have multiple months or whatever it might be and multiple rollover decisions, you're just buying one fund that does all of this for you. But you are giving up some upside potential. I mean, if you look during the 12 months, and Calamos has this graphic on their website, if you go to look for details on CPSL, you will see that in certain cases, you know, if you had been in the spider getting 20%, you'd be up 20. And this fund is going to be up closer to 7 because it's limiting your upside. So this can't be something you want to do with a lot of your portfolio. So what is that role that you want this fund to play in a portfolio?
So since I set you up for it, I'll answer it, but bear with me 1 second to point out, yeah, we haven't had a month that the market's been down. I don't think since CPSL's inception. It came to market in September of last year. And if we did, then I'm failing to remember. The market sold off earlier in the year and then very quickly snapped back. We haven't seen the true value that this fund, CPSL, can offer because we haven't seen the market sell off for a prolonged period of time. And I'm not rooting for it in any way, shape, or form. But people may want to use this fund, CPSL, to protect themselves. The two use cases to me are if you were worried about the market selling off and you were inclined to move and sell out of your S&P 500 base strategy, there's 4 ETFs and many mutual funds, you might move and sell it and go to cash. This CPSL is a better alternative to me in that you're getting some, not a lot, but some of that upside potential, and you're significantly reducing the downside that you'd end up taking on. The other part of it is instead of selling all of your position, is you could add, sell 10% of your S&P 500 exposure and put this in place of that. So you're getting more of the upside than you would if you were in this. You're not getting as much if you were in the S&P 500, but you took some of your chips off the table for a fee, of course, but some of your chips off the table. So we've seen advisors that are combining their S&P 500 base strategies, iShares and Vanguard and State Street have among those ETFs with this Calamos fund. And some people are using it as I just got to get out of the market, or I think I got to get out of the market because something bad is going to happen and the market's going to sell off.
This structure is somewhat similar to like equity indexed annuities and things along those lines. And the problem, having sat through many rubber chicken dinners about people making pitches on those things, is that they're often pitched as that equity alternative. You can get the upside, and you're giving up things like they'll measure the upside based on what does the S&P 500 do, but they're removing dividends from the equation to make it look a little bit better, et cetera. In those cases, the equity indexed annuity always seems to the audience like it's a stock market replacement, when what it really is kind of a replacement for a CD or your ultra conservative stuff. You're going to bring that return expectation way down because even if you think the market's going to do okay, you're going to give up so much of it. So while you said that people are using this as a strategy with their S&P 500 stuff for loss protection, does it more belong in like this is where you park cash because you're nervous and you don't want to be in a spot where you're going to suffer the loss, so you put your cash in something like this instead of using a money market fund, et cetera, because it has better upside?
Yeah, so to me, this is an alternative. So this is not equity exposure. It's also not direct fixed income exposure. To me, it's an alternative. And so for many people, they're building a portfolio. That's a broad bucket of things that perform differently than the equity side of the ledger. We've talked about gold. That's an alternative to me. We've talked about crypto. That's an alternative to me. This I would put in that same camp. Is it an alternative that's going to earn you the potential to earn more money in the equity markets? Or if the equity market does well, it's going to do better than you would in cash. If the market sells off, you're not getting a yield. You're just protecting the downside. So I think you have to, with CPSL, understand what it does for your portfolio and also what it doesn't do for your portfolio. If you're seeking income as a safe alternative, that's not this. If you're seeking some upside potential as an alternative, I think CPSL can fit in nicely into certain portfolios.
People are going to hear this and go, I'm still not sure I understand what it does. We've always put out, if you don't understand it, don't buy it. As we've made this, if we have failed to explain it to people, do you say the same thing? If you don't understand it, don't buy it? Or do you say, in this case, look, you're buying a product that has pretty much zero downside risk. So if ever you were going to buy a product that maybe you don't fully understand the inner workings of, it's one where you feel that there's pretty much a guarantee that you're going to lose no money?
So I'm a big believer that if you don't understand something and it's too complicated, then it isn't for you. If you think it's too good to be true, that you have almost zero downside and up to 7 or 8% upside, if that doesn't sound possible or plausible to you, you can either say, thanks, guys, I enjoyed the conversation, but I'm good, or go to the website. I think they actually do a really good job of showing you what's inside the fund, show you how they go about doing it, show you what you're giving up and what you're protecting on the downside. The Campbell's team they're experts in this options-based ETF world. I have confidence that they'll help you understand it. But if it seems too good to be true or seems too complicated, investing is supposed to serve a good purpose for you. And that's okay. You don't have to buy every ETF we talk about. In fact, I'm not suggesting you buy every ETF we talk about. That's 52 different ETFs in a given year.
Yeah. And this one will be more of an acquired taste. You definitely want to make sure you understand it. I will confirm what Todd said, the calamos.com website, fabulous information on these funds because they've had to figure out how to explain it to the public. And in this case, the fund we're talking about takes some explanation. It's the Calamos laddered S&P 500 structured alt protection ETF, CPSL, the ETF of the week from Todd Rosenbluth. Todd, great stuff. I'll see you again next week.
See you next week. Go Blue.
That's Todd Rosenbluth. He's the head of research at Vetify. Go to vetify.com for more information. And of course, Todd starts us off every Thursday on Money Life with the ETF of the week, and we are just getting started. Later, I'll be talking ETFs with Adam Coons, Chief Investment Officer at Winthrop Capital Management. But up next, Ed Campbell, principal at Red Hook Phoenix Investment Partners. He's here for the big interview. We're talking about, well, is it the end of boom and bust cycles? Yeah, kind of something like that, and a lot more next.
Everything an advisor needs in one newsletter. Go to advisorperspectives.com and see why 100,000 advisors are subscribed to our newsletter.
Welcome back to Money Life, where it's time for the big interview on today's show. I'm always asking you guys for what you want to hear more of on the show. And sometimes it's which guests you want back. Sometimes it's more on a certain type of subject matter, et cetera. And we've had a number of guests who have talked to us about the place where energy is coming together with AI and how that's playing out with infrastructure. And you wanted more from somebody who's kind of taking a look at that particular space. And that's why I'm talking today with Ed Campbell. He's principal and founder of Red Hook Phoenix Investment Partners, which is an independent advisory practice that he launched earlier this year, currently focused on the AI nuclear areas where they're trying to sort of put that all together and looking at next generation energy and next generation data infrastructure projects. Now, if you want to learn more about the firm, well, the firm is new enough that they don't have a website yet, but we always put LinkedIn addresses for our guests on our show page. So if you go find Ed on the recent and upcoming guest page, you will find a link to his LinkedIn where you will be able to then go and get more information on Red Hook Phoenix Investment Partners. By the way, Ed was the head of dynamic asset allocation and co-head of multi-asset at PGIM, which is the investment arm of Prudential Financial. Ed Campbell, welcome to Money Life.
Thanks, Chuck. Great to speak with you.
Let's start with an overview of the industry because, as I said, you're in this space where you're looking at AI as it comes together with nuclear power and nuclear. Well, all of the power industry has been watching sort of changes in what's going on in Washington. So give us a quick take here on where we are in our power needs and our power generation and how those things are changing and who's likely to benefit and who's likely to suffer.
Yeah, absolutely. So we are in the midst of a big build out that we're going to need to complete for energy consumption. AI is powered by data centers, and data centers are electricity hungry. I think nuclear is going to be playing the big role in enabling that. So if you look at the political environment, obviously a lot has changed since the person in the White House has changed. If you go back to Biden and the Inflation Reduction Act, there was a lot of subsidies for what we call green energy, in particular wind and solar. And that was a hot investment theme for a while, but we are now in the midst of a green energy default cycle where a lot of those projects are no longer economically feasible, in particular on the offshore wind side, right? So, for example, there were two proposed projects here in New Jersey where I live, where a lot of people on the shore were up in arms, about wind turbines 40 miles off the Jersey shore that were going to be visible from the beach. Well, that company wound up going bankrupt. And that's part of a broader green energy default cycle. Not only were the projects on shaky ground economically, but the subsidies are being pulled back under Trump, right? And in the One Big Beautiful Bill, one of the things that we've seen is a lot of incentives for nuclear, right? So I think nuclear is the solution for AI and data centers. First of all, they have it's an energy dense technology, so you can build nuclear facilities on a very small land print, and that is not the case with solar in particular. So I think nuclear energy is particularly well suited for data centers, which we need for AI, not only in terms of the land imprint, but also the fact that you have 24/7 reliable power, which data centers need, where green energy did not necessarily provide that. And, we've heard them referred to as the unreliables. But the AI nuclear nexus sort of fits into the theme of AI automation in general. And I see 6 mega forces out there that investors really need to internalize and invest around. And those include AI, decarbonization, geopolitical realignment, demographics, and digital finance.
Well, decarbonization kind of comes on the heels of AI and energy and putting that together. But having read your report on the cycles, the fact is that decarbonization is less about the market and more about the politics, right?
Yeah. So decarbonization would be the second theme of the 6 themes that we're emphasizing. So, and as you point out, it's a political super cycle, not a market cycle, right? So the transition is driven by not just private sector desires, but government mandates and subsidies. So not just pure price signals. Sometimes the subsidies giveth, and sometimes the subsidies taketh away, like we've seen in the case of the green energy subsidies. Another example is Spain's 2009 solar collapse when subsidies were cut. And, we see similar risks, as I pointed out, in the OBBB in the U.S., where policy has turned against green energy and toward nuclear, also less anti-fossil fuel. So I think the investment implications around that theme is durable plays include nuclear, grid, and transmission over policy-dependent renewals like wind and solar. The third theme that I think we need to invest around is geopolitical realignment, security over efficiency. So efficiency is out and security is in, and that means reshoring, defense build-outs, and friendshoring. It's not like the 2010s where we saw this big offshoring trend toward China. Those days are over. Ian Bremmer, who was my professor at NYU Stern, I took his class on geopolitical risk analysis. He calls it a geopolitical recession. So the Ukraine war, for example, redirected capital overnight. U.S. defense contractors and LNG exporters ultimately benefited. So the investment implications around the geopolitical trend is defense, cybersecurity, and industrial reshoring. We think of those as the secular winners. Demographics is another trend. We're experiencing, the great inversion of the population pyramid in the developed economies. So the developed economies are aging economies, and that means tighter labor markets, more health care, and suppressed real yields as we have less investment needs. And the youthful economies are the growth engines, and that includes India, Africa, and parts of Latin America. In markets, as in life, youth has the edge. So, for example, Japan's aging led to many, many years, more than a decade of equity market stagnation, whereas India is projected to add 200 million workers between now and 2040. So in that case, healthcare, biotech, and senior housing is what you want to emphasize in aging markets like the developed world. And infrastructure, housing, and credit is what you want to focus on in those youthful regions. Digital finance is the final trend. Stable coins and central bank digital currencies are basically collapsing monetary policy lags. So throughout most of my career, we thought about monetary policy lags lasting anywhere from 6 months to 18 months. But with stable coins, you have instant settlement. And, we've seen that market grow from about 20 billion in 2020 to 260 billion today. Those settlements now rival Visa. So I think the investment implication there is that flows are happening in real time and that we should expect more fragility, flash crashes, and cross-border contagion. So the next financial crisis might not start in banks. It might start in your nephew's crypto wallet, for all we know.
Yes, but part of the report that you're talking about, where you're looking at the forces and the end of boom and bust, which isn't to say that we're not going to have recessions, and it's not to say that we're not going to have market downturns, et cetera. It is to basically say that those will be short-lived events in a very long trend that moves us presumably always at least slightly forward, if not upwards. So is that also part of what we are seeing now as we are several years in to an economy that multiple times we've had, the most forecasted recessions never to happen in just the last couple of years, more than once? Like now we're forecasting it again and it just keeps not happening. Is that part of this fundamental change that you're talking about?
Yes, I think it is. So I think the old playbook, as you pointed out, was the cycles guided investors, right? So we looked for the stages of the boom bust, right? Expansion, overheating, recession, and then reset, right? So there you focused on the Fed, right? Because if you could divine the interest rate cycle, then you could unlock the key to the business cycle, right? And if you do that, then you could time sector rotation. And what I'm suggesting is that the cycles are now the background noise. The structural mega forces are the climate. So the business cycle has become the weather, where the mega forces are the climate. And in some sense, this makes investing easier and more strategic, because you can now position around the mega forces and worry less about things like sector rotation through the business cycle, which I've really not seen investors be successful in doing that, especially in the last few years. But I still think there's a place for short-term portfolio management around price moves and recognizing when a given trend is overbought or oversold. And, we're still going to have recessions. We haven't repealed the business cycle, and we're still going to have market declines associated with that. But I just don't think that's the way to approach your investing. I think that's going to lead to a lot of false positives in terms of recessions. In 2023, everyone was forecasting recession. It didn't happen. After the tariffs were imposed, we had another market decline. Investors were expecting recession, and that didn't happen either.
Let's go back to where we started, where we were talking about the changes that we've seen in the energy space and in infrastructure. Where are we in that cycle? Because obviously we are talking about the changes that have been made in the regulatory space, but I've talked to folks who have said that they now look at certain Bitcoin mining companies as more energy plays because they amassed so much in the way of energy resources that they're now more of an energy play for AI than they are a Bitcoin company. And maybe that's what happens. As you said, if we're going to get more digital on the finance stuff, maybe that's what happens when that industry matures. So are we at a spot, given all this demand, that we have the resources to keep up with it and not create problems going forward?
Well, we're at the early stage of the infrastructure build out that is needed. And when you talk about, for example, shortages, right, if we're going to build out nuclear in a way that provides the reliable electricity that we need in order to power data centers for AI, we do have a shortage of uranium, which is a critical ingredient, that a critical input that is required. Right. So I think, that's certainly something that's going to benefit places like Australia and Canada, our neighbor to the north, because if we no longer want to be getting critical minerals from Russia and China, and this sort of aligns with the geopolitical realignment, right? We're breaking up into blocks, right? Those associated with Russia and China, and then those associated with the American-led geopolitical realignment. So I think, the shortage on some of these things is going to positively impact Canada, which we see emerging as a global energy giant, and markets like Australia as well.
And do we get to a spot where policy can mess this up, or if we wind up with regime change or anything else that we wind up seeing massive changes just because we've had leadership changes?
That can certainly be. We know that the Trump administration, through the One Big Beautiful Bill, had, and through executive orders, a lot of policy changes that were favorable for nuclear. The regulatory hurdles are still pretty high, but there has been some progress on streamlining those. We're early in the Trump administration, so we've got policy certainty at least for the next 4.5 years, or whatever time is left. But certainly, if we do get leadership change in the next presidential election, that could certainly result in policy whiplash.
Well, we will be watching how it turns out. We will see what that means for the energy space and the rest. Ed, really interesting conversation. Thanks so much for joining me on Money Life to talk about it all.
Thanks for having me, Chuck. I enjoyed the conversation.
That's Ed Campbell. He is founder, principal at Red Hook Phoenix Investment Partners, an independent advisory practice. You're going to have to go find them on LinkedIn if you want to learn more, because there's no website, but we have that LinkedIn address up where you find them on our Money Life Show recent and upcoming guest page. And we'll be back with more of Money Life in just a moment. Stick around.
Exchange is more than a finance conference. It's a community. Join us to gain insights and connections that last. Visit exchangeetf.com.
Adam Coons, Chief Investment Officer for Winthrop Capital Management, is here. We're talking core and satellite investments using ETFs. It's market call time. Welcome to the Money Life Market Call, the part of the show where we talk with experienced money managers about how they do their job, what they look for that determines their buys and sells, what they see happening broadly on the market today, and how they put it all together. And returning to the show for the first time in several years, but a guy who I like how he puts it together, because it's the kind of thing that he's doing for clients whose portfolios look kind of like yours. Adam Coons. He is Chief Investment Officer at Winthrop Capital Management. You can learn all about the firm by going to winthropcm.com. But yes, they do core and satellite investing, which, by the way, is kind of how I invest to a great extent too. Again, if you want to learn more about it, winthropcm.com. Adam Coons, great to have you back on Money Life.
Hey, thanks for having me.
Let's start with methodology because, well, we need your explanation for core and satellite in terms of how you're building a portfolio, but we also need to know how you're getting down to the brass tacks and saying, these are the funds I want to play those roles of core and satellite.
Absolutely. Yeah. So in that core satellite model, really what you're doing is you're creating a discipline where you kind of keep it very simple with the core, right? Think of your S&P 500 or just an MSCI kind of all world index like the ACWI for your equity exposure, and then maybe something like the Bloomberg Aggregate Index on the fixed income. So those would be your kind of your staple, your foundation that you're building a portfolio around. That's going to give you your passive return. And then where we're trying to take tactical allocations, those are the satellites. So those are the outsized bets, whether that's maybe you want to overweight AI, which everyone seems to be wanting to do right now, or you want to play around the duration of your fixed income. You would do that with those satellites. So the additional ETFs that are much more micro focused on a specific industry or a factor, that would be the satellites. And so how we determine how we're allocating the satellites versus that kind of core piece are two very generic but broadly used methodologies. One is that if I encourage everyone to read Howard Marks' books. He is known as a fixed income investor, but speaks to all asset classes in that there really is this idea of things that are overbought or oversold, and just keeping it really simple and shifting is that when, there's the most fear in the markets, usually the time to buy. And when there's the most over optimism is probably the time to take some chips off the table. So that generic model is how we kind of decide our kind of risk band that we have in our portfolios. And then we determine, how we're allocating that risk, because we do kind of see ourselves as risk allocators, not just asset allocators. And so we use the model that was famously used with Bridgewater, a very large hedge fund, is using the macro model around the regimes of inflation and growth. Those are really the two big catalysts for what the economy does, and then obviously how that affects capital markets. So you've got your kind of quadrant where you've got inflation that can be up or down, and growth that can be up or down, and a mix of those will determine, how you want to allocate your risk. And how do you want to, be in different sectors, because they react differently. Do you want to be in credit, or do you want to be in kind of a risk-free type fixed income instrument? Do you want to be in high beta, low beta, growth or value? Those are all really driven by growth, inflation, and how those are moving and changing over time. So that's a real kind of fundamental look into how we construct our portfolios.
So how are you balancing it now? Because again, the core stays the core, but we're talking with people all the time on this show. And like right now, there's this great dichotomy of the folks who are saying valuations are stretched and I'm worried that something bad's going to happen versus the ones who were saying earnings are strong. And as long as earnings are strong, valuations aren't all that important. So how are you balancing that to decide those satellite positions and the tilts that you're putting into place?
Yeah, absolutely. So evaluations are stretched, and that does play a role in how we're deciding to allocate. The way to look at that from our standpoint is you never really want to just react. And as we see valuations push further and further out, we are just incrementally moving away from growth and away from the core S&P 500 and moving towards defensive strategies. And so here looking at higher dividend type funds, or we really like the low vol. So something like a USMV, for example, is a low vol ETF. And what it does is it just looks and scores the stocks within the S&P 500 that generally have a lower volatility and overweights those. And so that's a way to play defense, but we're not moving all into that. I think the really important thing to remember is that, valuations in and of themselves are not a reason for stocks to go down. It means that there's a lower margin of safety. So what we're doing is incrementally moving towards more defensive, but not moving all in or not moving to cash, because this can go on for quite a while. And you hit the other part of this is the reality is earnings continue to grow. We're going to kind of be bumping up against that 10% earnings growth for the S&P 500 for this year. So until that changes direction, it's unlikely that we'll see some sell off. Now, like I said, the margin of safety is smaller, so the punishment for missing earnings is going to be greater the higher valuations are. But for us, we kind of see this as the momentum is probably here to stay, and so we're really balancing that line around neutral, and that's not exciting, but it's important to know when you don't have a lot of conviction to just sit at neutral, and that's okay. And that's really just about where we are right now.
It's interesting because that was not a sentiment I had heard a lot from the people we talked to. And you are now like the third person in the last week who has gotten to where, yeah, we're at this neutral thing because we don't want to stop dancing while the music's still playing, but we're worried about the valuations in the stretch. What are you doing when it comes to international right now? Because again, on your satellite side, you can also be you can be generic and say, I'll lean into international, or you can be specific and go, I'll lean into fill in the blank country. So where are you on international right now?
Yeah, absolutely. Great point there. So admittedly, coming into this year, we were more defensive heading into what was the downdraft of the US market in March and April. So we got that right. But I'll admit that what we got wrong was being underweight to international. And what you saw at its peak, the delta between developed international stocks and the S&P 500 was around 17%, meaning at that point, international stocks were outperforming the S&P 500 by that much. So we kind of looked at ourselves and looked at our allocation. Even though we were underweight international already, we took it further at that point because that gap, that delta was just too far. And I understand there were a lot of outflows from the U.S. You saw it. The U.S. dollar was down, U.S. bonds were down, and obviously U.S. stocks were down. It was just a mass exodus from U.S. markets when kind of had the tariff tantrum. That was just too much of a difference, 17%. So at that point, we actually moved even further underweight international, and that did work out. So you've seen that collapse down from 17% to now international equities are outperforming roughly around 10% on the year. So you've seen obviously the U.S. markets catch up, and so now we're starting to move that back towards neutral again. So like I said, we obviously took a heavier bet, and I'm going to keep saying, probably said the most boring thing you can say in asset allocation is just moving to neutral, but there's not a lot of cause for us to move away from that. So because of that, we are moving towards a neutral position, both domestically and internationally. But I would say the caveat is that's in the developed countries. When it comes to emerging markets, we are going to remain underweight. And that largely is a US dollar story. We don't have to dig in too much there, but it's important that when you're thinking about emerging markets, that you need to be thinking of the US dollar. It's not just a play on some sort of growth in those countries. There's the factor of what does the US dollar do? Is if it's appreciating, that is negative for emerging markets. Their debt becomes more expensive. They tend to, borrow in US currency, and so paying back their debt becomes more expensive, and that can lead to kind of what we call on the debt side a doom loop, where you got interest rates that may be going up at the same time paying back that interest is getting more expensive. So that's one of the things we're seeing kind of on the horizon potential for the emerging market. So that's why we're underweighting there.
And going back to neutral, I mean, it is moving. It's rebalancing, and it's a move that gets you back to sort of the basics.
It is.
And it is something that we have, like I said, heard a little bit more of. What is that doing for you on the fixed income side? And what are you leaning towards? And again, are there any specific ETFs that kind of like this, as we get to neutral, here's about as neutral as we get and like to be?
Yeah, for sure. So on the fixed income side, I would say that's probably where we're getting a little bit stop short of using the word creative or exciting when it comes to fixed income, because no one will ever say that. But I would start to look at different duration strategies. You've seen credit spreads tighten quite a bit. But one of the big allocations that we've shifted towards over this year that we haven't in the past are mortgage-backed securities. And so if you look at the MBS market, spreads widened out there quite a bit, in particular because the Federal Reserve has let that part of their portfolio completely start to run off. They're not reinvesting coupon payments from MBS. And so that led, without that natural buyer, that led to spreads widening. And so this was, a period in my somewhat short career of 14 years in this industry that spreads are the widest they've ever been in my career for mortgages. So for that reason, we gave it a good hard look, and so we have overweighted mortgage-backed securities within our portfolios for that reason, because you're getting more spread than you are even in a corporate bond.
Well, now we're going to get your quick and dirty take on some ETFs that my audience is particularly interested in.
Quick and dirty.
Talk is cheap. Perhaps a test of thy faith.
Well, actually, we're going to put Adam to your test so that you can then decide if you have the faith in his picks. Adam Coons is the Chief Investment Officer at Winthrop Capital Management. Go to winthropcm.com to learn more about the firm and about Adam. Quick and Dirty is our lightning round. It's where we put our guests to your test. If you want to test our guests in the future, send your name, your hometown, and the ticker symbols you're interested in to chuck@moneylifeshow.com. We will add them to our list and hope that they make it into an interview soon. And we're going to start with what I think is a softball, but maybe not, because when you talked about what you liked, you were talking about low volatility, and you mentioned the USMV, which is the iShares Minimum Volatility Fund. But Tom in Smithfield, Kentucky, he wants to know about Fidelity's version of that. He wants to know about the FDLO. That's the Fidelity Low Volatility Factor ETF.
Yeah, I like the Fidelity model here. It's a low cost version similar to the USMV. The asset allocation tends to be a little closer to the S&P 500. So that's one thing you want to look at in some of these different low vol strategies is how do they allocate? The USMV tends to let itself drift towards underweighting those, higher beta different sectors and balancing itself that way. But other ones, what they'll do is they'll try to run the sectors within the model close to the S&P 500, but just pick the low volatility stocks within those sectors, and that's what the Fidelity version uses. So it's gonna match closer to the S&P 500 with a lower beta. So I do like it, low fee, everything. It's good.
Would you mind stepping aside? I've got a purchase to make.
So that's a buy on Fidelity Low Volatility Factor, FDLO. Richard in Chula Vista, California wants to know about the SPDR, State Street Global Advisors Multi-Asset Real Return ETF. That's ticker symbol RLY.
Yeah, so I got to be a seller here, and I'd be a seller of any of these type of funds that essentially has taken a basket of a bunch of different ETFs and then throws it into this wrapper and puts an additional fee on it. And it's just not worth that additional fee. Go to the tear sheet, see the underlying holdings, and just buy those. Their ETFs are what make up this thing. So why pay the additional fee when there's really no reason to?
And I mean, there are going to be some people who hear that and might be alarmed because it's not just about that specific fund. That's about fund of funds generally.
Yep.
Would that apply to somebody who is taking, for example, the default choice in their 401k and going, I want a life cycle fund or what have you? Or do you find that in that case, it's probably okay because they're holding the extra fees down?
Yeah, I'd probably say that. Yeah, like, in some sort of 401k type idea where it is set it and forget it, that I think you just kind of have to take what you take there. I'm thinking more about your listeners, probably little bit more active and a little bit more involved with a portfolio. So that's where I would, guess that a listener of yours would be able and willing to go and just buy those individual securities.
I just want to make sure that we're getting it right. And as it applies specifically, like it's not a blanket, all of them are evil when it comes. But when you were talking about finding that multi-asset real return, we're talking about picking those individual ETFs yourself. That's why the Spider SSGA multi-asset real return fund,
I'd have to advise against that.
that was a sell or an avoid. Let's move over to fixed income. Again, this may be a softball because you told us you like mortgage-backed securities. Stan in Driftwood, Texas wants to know about VMBS. That's Vanguard Mortgage-Backed Securities.
Yeah, I like this. There are a few different varieties and flavors of MBS, but I like the Vanguard product. Once again, low fee. You really want to pay attention to that. The overall mix of mortgages within that ETF is solid, meaning that there are some more age mortgages, mortgage pools, and some newer ones. So you get a mix of different coupons. One of the things, we don't need to get too technical, but one of the things that can deter from the return are prepayments of mortgages. So this one has a lower risk of that. So I like it. You're going to lock in that additional spread. So yeah, absolutely a buy.
When you hear the word go, you just try to grab it.
Yep, in this case, you are grabbing the Vanguard Mortgage-Backed Securities ETF, VMBS. Dan in Williston, Vermont wants to know about kind of the parking place for money. Since you talked about getting neutral, it's VGSH, Vanguard Short-Term Treasury.
Yeah, so I would say there's a better option here. So this particular fund just invests in U.S. Treasuries. It's your lowest risk, but also going to be your lowest yielding. I would look at something like SPSB, and so this is the exact same structure. It's a 1 to 3 year maturity, but it's with corporate bonds, and because you're buying corporate bonds, you're going to get a roughly 65 to 70 basis points of additional yield. And because the duration is so low here, it's a much lower risk around interest rates and even with spread widening. So when I'm looking at corporates, we really like corporates on the short end. We think it's worth the additional, credit risk, like I said, for that 65 or 70 basis points.
You seldom hear Vanguard basic funds be talked down, but
No soup for you.
in this case, no soup for Vanguard Short-Term Treasury, VGSH, and the buy in this space instead was the SPSB. That is the Spider Short-Term Corporate Bond ETF.
Buy it outright.
And last, for DA in Honolulu and Stephen in Flower Mound, Texas, we're going to turn to TIPS and Treasury Inflation Protected Securities. It's the PIMCO 1 to 5 year U.S. TIPS Index ETF, STPZ.
Yeah, so right now, I probably would just buy treasuries. I think the thing, if you're buying tips, you need to know how they work and when they outperform. You want to buy tips when you think inflation is going to be higher than expected. Right now, tips are pricing in roughly 2.4% inflation over the next 10 years. And so if you have a reason to think that it's going to be higher than that, and you can outsmart the market, then you go buy tips. But otherwise, it's already hedged out. So if it's not above that, you actually lose out relative to buying treasuries. So I think a lot of people will get confused around tips and thinking that it's just outright an inflation hedge. It's not. It's a hedge against expected inflation versus actual. So really important to keep that in mind. So if you do think inflation is going to come north of 2.5% over the next decade, go buy those tips. Otherwise, stay away.
And it's interesting here because what you said was go with treasuries. Of course, a minute ago, you didn't like the Vanguard short-term treasury. So I am going to ask, you're going with the treasuries if your allocation decision was treasuries. You'd rather be in treasuries that are not inflation protected than treasuries that are if you're going to do the treasuries, but you might prefer that corporate space even better than both, right?
Yes, and it does depend. So, like I said, the tips is a longer duration product. So, if I'm in the short end of the curve, I want to be in corporates. But if I am moving out to the 10-year space, I am more okay with treasuries. I think locking in just the yield and not having all that credit risk is probably a smarter play. And that's actually how we're doing our portfolios, is what you call a barbell. So we have credit on the short end, and then a long end of the barbell, we're doing risk-free treasury. So that does align with our allocation in general.
But again, when we get back to the STPZ, the PIMCO 1 to 5 year US Tips Index ETF,
Whoa, dumber than advertised.
yeah, just go after the treasuries in the same space. And you know what was every bit as good as advertised? This conversation with Adam Coons. Adam, great to have you back on the show. Thanks so much. We'll talk to you again down the line, I hope.
Yeah, thank you. Looking forward to it.
That's Adam Coons, the Chief Investment Officer at Winthrop Capital Management. WinthropCM.com is the website if you're looking for more information. And we'll come back to put a bow on this show. Don't quit before we get to the finish line. We'll be back in a moment.
Looking to earn CE credits and hear from top portfolio managers? Go to etftrends.com/webcasts and learn more. Hi everybody, Rob Floyd, Money Life's executive producer, and I'm back with another contest where you can win a book that was discussed on the show. On Tuesday, Chuck interviewed Victoria Bateman about Economica, a global history of women, wealth, and power. The book is all about how women made the world rich, and rich women is what this week's contest is about. Specifically, you have to tell us who Forbes magazine currently counts as the richest woman in the world. Send your answer to chuck@moneylifeshow.com by noon Eastern Time on Saturday, October 4th, to be entered into a drawing to win the books. And please put the word contest in your subject line. Good luck.
We're back to wrap this one up. I hope you enjoyed that interview. You know, it's very different when you talk to a financial advisor, someone who puts together portfolios for individuals, versus a fund manager. And we don't talk with that many guys who do what Adam Coons does, not because we don't want to, but because frequently they have compliance officers who are like, you can't talk individual investments, which is bogus because obviously they can. I had one the other day where they had pitched me a financial advisor, and it wasn't that the guy wasn't impressive or what have you, but, you know, he was managing, I don't know, $500 million, which sounds like a lot until you go, wait, hold it. I mean, even consider yesterday when we had David Bush on the show from Trajan Wealth, that's a money manager with $2 billion, something along those lines. Compare that to Jeff Blazek from Neuberger Berman, which has like $600 billion. Then go, okay, and then here's the local planner. And it's not that there's anything wrong with those local planners. There's not. But again, it's the guess that you're expecting us to give you and the gravitas that they have. But when we get someone who says, yes, I want to be on your show, and they're from a smaller place, I will usually say, let's get you to the market call and talk individual names. And it's fairly common that they won't do it. And they'll say, you know, our compliance guy says whatever. Okay, well, we've done a few thousand interviews, you know, and we've never had a compliance problem. It's not true. We one time had one compliance problem where a guy said something that was super outrageous. And I actually stopped in the taping and I was like, are you sure you want to say that? Because I love that you said it. And he's like, yes, I definitely want to say it. I'm like, okay. And then I wasn't surprised to hear that compliance had problems and he wound up getting a phone call from the regulators. But that doesn't happen normally. And in part, it's because when you're building a portfolio, there's nothing wrong with saying this is what I would use. But it is a different methodology, right? A fund manager is looking at something without regard to how it fits for an individual, how much they might change things, et cetera. And a money manager working for a family or what have you is a little bit different. But love getting a chance to do it. Love some of the things we have coming up, including tomorrow. Dan Zanger, Chief Technical Officer at chartpattern.com, returns to the show. We'll have Ray DiBernardo, Portfolio Manager for the XAI Madison Equity Premium Income Fund. He will be here for the Navigator, and we've got a lot more. So plan to be here. But also coming later this month, guys like Meb Faber from Cambria Investments and Rob Arnott, Stephen Gray from Gray Value Management, Tobias Carlisle from the Acquirers Funds. We actually think we're going to do 2 interviews with him because he's got a new book out. And speaking of books, well, we do not have Richard Thaler coming to talk about The Winner's Curse. Richard Thaler, the Nobel Prize-winning economist on behavioral finance, but his co-author on his new book, The Winner's Curse, Behavioral Economics Anomalies Then and Now, is a guy named Alex Imus. He will be here. John Campbell, the co-author of Fixed, Why Personal Finance is Broken and How to Make It Work for Everyone. He's coming later this month. We'll have contests, I think, for both of those books. We've got a contest going now. Come on, get your stuff in. You can win. We'd love to have you win. And we've got a couple of great people coming to talk technicals and more. And then we get into November and December, and those are normally fabulous months for the show because you've got everybody prepping their year ahead outlooks. And yeah, we've got some great things coming in. And oh, by the way, even in the interviews I talked about, Jeremy Schwartz, the Global Chief Investment Officer for Wisdom Trees here next week, Cheryl Smith, the economist at Trillium Asset Management, Mike Green from Simplify is coming back, Dave Rosenberg from Rosenberg Research, Christian Chan, the Chief Investment Officer at AssetMark. Oh yeah, it's going to be a good month. Meanwhile, if you're looking to make today better, well, today is Yom Kippur, and I hope for all my brethren who are out there celebrating, or maybe not so much celebrating, because it's the Day of Atonement. It's not a big celebration thing. I do hope you have an easy fast. For everyone who is not doing that and looking for something else to celebrate, National Custodial Workers Recognition Day. It's also National Name Your Car Day. I used to name my cars. I don't anymore. I don't really know why I don't. Maybe I should. It is Audiophile Day. Of course, an audiophile is a person especially interested in high-fidelity sound reproduction. That would be me to an extent. It's Rob Floyd, my producer, for sure, and I very much appreciate him. And then on the food front, although it's Yom Kippur, so maybe I shouldn't be celebrating food too much, National Produce Misting Day. That's not so much about food as what you do with ingredients. National Fried Scallops Day and National Smarties Day, which, by the way, was started by the folks who make Smarties candy. And I said yesterday with the Jiffy Mix thing, I don't love holidays that are started like, hey, celebrate us. Whatever. My guests today were Todd Rosenbluth, the head of research at Vetify. Go to vetify.com for more information. Ed Campbell from Red Hook Phoenix Investment Partners. Again, no website yet for them. LinkedIn, we have it tied up in our show notes. And then Adam Coons from Winthrop Capital Management, winthropcm.com. Thanks to them. Thanks to Rob Floyd, my producer. Thanks to Maho, my dog. But mostly thanks to you for being here, because you make this special and worthwhile for me each and every day. The Money Life quote of the day comes from Kenneth E. Walden, who said, "Do not argue with the market, for it is like the weather. Though not always kind, it is always right." Yeah, it does not make sense to argue with the market. It makes sense to look inward and find your right balance. And to that end, no matter what the market's doing, you should remember that until we do this again the next time, the best thing you could do for your money is not worry too much about it. Have a great day, everybody. Stay safe and calm. We'll see you here again tomorrow.
The people who appear on Money Life are here for your and their own entertainment. Don't take advice from us or any other podcast without doing more research and/or consulting your financial advisor. We believe our guests provide reliable information, but we can't and don't guarantee the accuracy or completeness of their statements. Opinions expressed on Money Life are those of the host and guests only and reflect their personal thinking. They're not representative policy or strategy of any employers or sponsors. This show is produced by Money Life Radio, which retains all rights to the content. If you want to use any part of this show for your own purposes, be they good or evil, you must get our written permission first. And remember, with great financial information comes great responsibility. Please act responsibly.
You need rest. Go back to bed.